Good evening. Tonight, we turn to a story from Main Street, not Wall Street, yet one that's deeply tied to both. Trader Joe's, the quirky, quietly powerful grocery chain known for its Hawaiian shirts and private label products, is in expansion mode. Behind those friendly aisles of snacks and frozen meals lies a serious business strategy unfolding across the U.S. retail map, one that investors, analysts, and competitors would do well to study closely. At the center of it, a new wave of openings. According to recent corporate disclosures and local business reports, Trader Joe's is preparing more than 30 new stores across 18 states, stretching from Connecticut to Texas, from New Jersey to Utah. It's one of the largest concurrent rollouts in the company's history. The expansion story. In New Jersey, the town of Easeline, Woodbridge, will soon welcome a new Trader Joe's in a high-traffic shopping zone, a site already buzzing with footfall. Over in Houston, 2 new stores are joining the area, one in Cypress and another in Kingwood, both strategically placed in fast-growing suburbs. Houston Business Journal, October 2025. Meanwhile, in Connecticut, construction has started on a new location in Hamden, replacing a former LA Fitness at 46 Skiff Street. The building size and parking make it an ideal candidate for Trader Joe's typical 10,000 to 15,000 square foot format. And in Bee Cave, Texas, a suburb west of Austin, the chain is nearing completion on a $5.7 million site at Shops Parkway, Central Texas's 4th Trader Joe's, and a signal that the company wants deeper roots in the state. These aren't random dots on a map. Each new location follows the same careful logic: middle to upper income demographics, strong commuter traffic, and manageable real estate costs. The rollout represents the kind of cautious, organic growth that's defined Trader Joe's for decades, but now the pace is picking up. A quiet empire. Founded in 1958 and acquired by Germany's Aldi Nord Group in 1979, Trader Joe's has always operated under a low-profile model. No flashy advertising, minimal press engagement, no online sales. Its brand is built on word of mouth and scarcity. Shoppers feel they've discovered something. 4 years, that deliberate restraint limited growth. But times are changing. With roughly 600 stores nationwide and a footprint that's still sparse in the Midwest and South, Trader Joe's has plenty of room to run. The current wave of openings marks a transition from boutique regional chain to something approaching national scale. Yet growth brings risk. Expansion means capital expenditure, supply chain strain, and the challenge of keeping culture intact. For a brand that thrives on quirk and intimacy, growing too fast can blur its identity. The balance between scale and soul is the tightrope Trader Joe's now walks. The business mechanics. Let's break down the economics of this expansion phase. Capital investment. Building or renovating new sites isn't cheap. Industry sources estimate that a new Trader Joe's store, depending on market, can cost $5 to $8 million in build-out, permits, and initial inventory. Multiply that by 30 sites, and we're looking at well over $150 million in development spending in the next year. Operating leverage. Each additional store adds to fixed costs, distribution, logistics, regional management. But if sales scale accordingly, operating margins can improve. For Trader Joe's, where margins are already stronger than many competitors due to private label focus, this could yield long-term upside. Supply chain complexity. The retailer sources globally for its products, from olive oil in Spain to frozen meals from Thailand. More stores mean more pressure on the logistics network, and potentially on supplier relationships. Expansion success depends on how efficiently Trader Joe's manages that scaling. Labor and culture. Trader Joe's employees are a major part of its brand experience: friendly, informed, invested. Maintaining that across dozens of new locations means substantial training investment and HR focus. Rapid expansion could test the consistency of that culture. Competition and differentiation. The grocery landscape is packed. Walmart, Target, Costco, Whole Foods, regional players, and online giants like Amazon Fresh. Trader Joe's edge lies in limited assortment efficiency, roughly 4,000 items, nearly all private label, and high inventory turnover. It's not trying to be a supermarket. It's a specialty store that acts like a brand. That clarity has been its financial shield. Market context. Economically, timing matters. The U.S. consumer is strained. Inflation, while easing in official data, still bites in food categories. Yet grocery remains a defensive sector. People must eat. What's shifting is how they shop. Smaller trips, value-driven choices, curiosity for quality at lower cost. Trader Joe's sits squarely in that sweet spot. Its combination of premium experience and affordable price points aligns with current consumer psychology. On the real estate side, a wave of retail vacancies in suburban and mid-tier malls has opened prime space at lower rents. Trader Joe's expansion may partly be opportunistic, securing leases in desirable neighborhoods while rates remain favorable. Financial implications. For a company that doesn't publicly disclose financials, analysts rely on estimates. Private label grocery operations like Trader Joe's typically earn net margins around 6 to 8%, far above the 2% norm in traditional supermarkets. With store-level sales often averaging $1,700 per square foot, compared to about $600 for larger chains, each new site has strong revenue potential. However, early months of operation can run thin as stores ramp up. The costs of staffing, training, inventory stocking, and local promotion often mean payback takes a year or more. The financial test for this expansion is whether each new site meets or beats expected sales velocity within 12 months. Lessons for business watchers: growth is strategy, not speed. Trader Joe's expansion, while large by its standards, is still deliberate. Every store has to reinforce the brand story, not just add square footage. Real estate matters as much as marketing. Choosing locations in stable, high-income suburbs protects store performance. Private label equals margin control. By owning nearly all its products, Trader Joe's buffers itself from supplier pricing power and passes savings to consumers. The brand moat is experience. The Hawaiian shirts, the handwritten shelf tags, the tasting stations, these are operational choices with financial consequences. They create retention, reduce churn, and lower marketing spend. Broader implications. For the U.S. retail economy, Trader Joe's expansion is a small but telling signal. Amid store closures elsewhere, a grocery chain is opening dozens of new doors. That suggests two things: a resilient middle-class appetite for differentiated value and a recovery in physical retail demand. While e-commerce continues to grow, shoppers still crave in-person discovery, something Trader Joe's delivers better than most. If the company can sustain this expansion wave while protecting its unit economics, the ripple effect could reach suppliers, logistics providers, and even commercial real estate markets. It's a quiet but significant story of confidence. Closing thought. At surface level, Trader Joe's is a friendly grocery chain adding more stores. Beneath that, it's a study in disciplined scaling, turning culture into commerce, nostalgia into nationwide reach. Each new location represents not just a ribbon cutting, but a strategic statement, growth done on its own terms. So while Wall Street chases tech IPOs and crypto swings, Main Street's quiet operators, like Trader Joe's, keep showing how consistent vision and controlled growth can create lasting business value. For now, the aisles are expanding, the brand is holding, and the markets are watching. That's tonight's story, a business expansion wrapped in Hawaiian shirts, moving methodically across America. The kind of story that reminds us growth doesn't need to shout to be strong.